Tata Chemicals has reported subdued set of numbers in the quarter ended September with compressed margins despite a decent uptick in its revenues. Let's do a three-point analysis on the highlights of Q2 earnings and what's the outlook going forward. 1. How has the company performed in Q2? Well, despite a 10% year-on-year surge in the revenues, there has been a 3.5% dip in margins owing to high input costs, weakness in the international operations and one-offs in the US and Africa, and also the high energy costs. Now, net profit of the company grew at 17% year-on-year, which was facilitated by a sharp surge in the other income as well as lower tax expenses. Now, domestic businesses also saw 23% healthy growth year-on-year in revenue on the back of healthy volumes and strong growth in the consumer business as well. Now, higher fixed input costs and lower trading of soda ash impacted profitability of the European business. Now, there was a strong demand in the US. However, the company suffered production loss due to installation of equipments which adhere to new environment norms. 2. What are the company's expansion plans now? Well, if you see, the company is planning a capex of around $370 million at its Mithapur plant over the next 3 years for capacity enhancement in cement, soda ash and salt. It will also start capacity to manufacture pharma-grade bicarbonate. Now, Tata Chemicals is also working to upgrade its silica plant to make it compliant with the environment norms. The plant at Nellore for the company's nutritional solution business is currently in the investment phase as well and is expected to start in Q4 FY19. Now, given the upcoming demand for electric vehicles in India, the company also announced plans to enter the lithium-ion battery manufacturing space as well. 3. What's the outlook on the company now? Well, if you see, the management has indicated that post the supply constraints from China, the growing Turkish capacity is getting fully absorbed and the tightness in the market still continues. Now, this would enable them to pass on the higher input costs in various geographies. And with most of the contracts up for renewal towards Q4 of the current year, the benefit of this should flow in from that quarter as well and would provide relief to the margins.